Welcome back to Investing Talk Podcast. Today we're zeroing in on a company that's been making some pretty significant strides in a really crucial sector, Sterling Infrastructure. And the big question we're trying to unpack for you today, looking at all the data we have as of, well, July 2025, is this. Is Sterling Infrastructure a good time to buy now? Before we get into all the fascinating details and help you sort through this, if you find this analysis helpful, please take just a second to hit that subscribe button. Give us a like too, but maybe leave a comment below. Your engagement, it honestly helps us keep bringing these kinds of analyses to you. And hey, you can also support the show, maybe buy us a coffee. We really appreciate the support. Oh, and if there's a specific company you'd like us to look into down the road, just drop its name in the comments. We definitely look at those.
Yeah, absolutely. And that's really our mission here today. We want to break down the key factors, the things really influencing Sterling Infrastructure's stock right now. Our goal is to give you those critical insights, those nuggets of knowledge, to help you understand the different angles, the different perspectives. So you can ultimately decide for yourself if this makes sense for, your own investment approach and goals.
All right, then, let's pull back the curtain on Sterling Infrastructure. Before we even touch the stock price, we got to understand what's really under the hood. So what are the core numbers, the fundamentals telling us about this company?
Okay, so looking at the top line, their revenue, it's actually expected to see a small dip, about 1%, in fiscal 2025. So that brings it to roughly $2.09 billion. Now, that might sound a bit concerning at first glance, but here's where the story gets more interesting. It's forecasted to bounce back pretty strongly in 2026. We're talking like 8% growth, pushing it up to around $2.26 billion. But what's really impressive, and maybe more telling right now, is their profit margin improvement. In Q1 2025, they reported, get this, a 29.4% year-over-year EPS growth.
Wow.
Yeah, and their adjusted operating margin expanded by 618 basis points.
Whoa, okay, 618 basis points. That sounds like a lot. Can you put that into perspective for us? What does that really mean?
Sure. So 618 basis points is 6.18 percentage points. That's a huge expansion in how much profit they're making from their core operations. And this isn't just, random luck or some temporary thing. It seems driven by a very deliberate strategic shift. They're moving towards more mission-critical, high-margin projects, especially, and this is key, in the data center space.
Oh, data centers, okay.
Right. And this focus, it's clearly hitting the bottom line. Earnings per share, EPS, is estimated to jump a huge 41% in fiscal year 2025 to $8.61. And then it's projected to grow another 10% in fiscal 2026, up to $9.48. So what this really signals for you as a potential investor is a company that's not just growing sales, but it's intelligently finding profitable growth. They're kind of moving up the value chain.
That strategic move into data centers is really interesting. Are we talking just like building the shells? Or are they doing the more complicated stuff inside too? What makes it mission critical enough to drive those higher margins?
That's a really good question because it gets to the heart of their edge. When we talk mission critical, especially for data centers, it's not just about pouring concrete. Sterling often gets involved in the really specialized, complex infrastructure inside those buildings. Think power distribution, specialized cooling, fiber optic networks.
The really vital systems.
Exactly. The stuff that if it hiccups for even a second, you've got major problems for computing operations. It demands high-level engineering, precise execution, sometimes custom solutions, and that's what lets them command those higher profit margins compared to, say, more standard construction work. It's a niche where reliability is everything, and it seems they've built a strong reputation there.
Okay, that makes sense. Profitability sounds great, but it often depends on the company's overall financial health. So what about their balance sheet? Do we know much about their debt levels, their cash flow? Are there any red flags there investors should watch out for?
Well, the sources we looked at don't give super detailed recent numbers on debt and cash flow, which, sometimes leaves you wanting a bit more clarity.
Right.
However, what is detailed, and it's a very strong positive indicator for their financial health and future liquidity, is their backlog. It's significant. As of the first quarter of 2025, Sterling Infrastructure had a massive $2.13 billion in committed projects lined up.
$2.13 billion.
Wow. Yeah. Think of it like a home builder with orders already signed for the next couple of years. This backlog gives them really strong visibility into future revenue. And it suggests they have a solid base of liquidity to keep operations running smoothly. It implies they've got a ton of work already secured, which should translate into future revenue and, cash generation down the line.
So even without the granular cash flow statement, that backlog is a pretty strong signal about future money coming in. That's helpful. Now, Shifting gears a bit, every company lives in a bigger world, right?
Hmm.
An industry. Where does Sterling Infrastructure fit into this complex infrastructure landscape? But what's their secret sauce? What gives them a real edge?
Right. This is where their strategy really shines, I think. They operate across three main segments. There's e-infrastructure, that's the digital stuff we talked about. Then transportation, think big road and bridge projects. And also building solutions. Their competitive advantage seems really honed in on that mission-critical infrastructure niche, especially those data center projects. Get this. Over 65% of their e-infrastructure backlog is now tied to data centers.
Over 65%. Okay, they're really leaning in there.
They really are, and it's incredibly well-timed. Strategically speaking, it aligns perfectly with these huge macro trends reshaping things. You've got the AI explosion, right, which needs more and more powerful data centers. And then you have all this government infrastructure spending coming through, things like the IIJA, that's the big infrastructure bill.
Right, the Infrastructure Investment and Jobs Act.
Exactly. And the Cheat ES Act for semiconductors, plus the Inflation Reduction Act with its clean energy and infrastructure money. These are tailwinds that should last for years. And importantly, they're not just passively benefiting, they seem to have a reputation for efficient project management, for getting things done on time. In this industry, that's not just marketing fluff. It leads to repeat business, better project opportunities, especially with clients who absolutely cannot afford delays or failures.
So, strong operations, smart strategic positioning. Okay, the next obvious question is, what's the market willing to pay for all that? How does Sterling Infrastructure look from a valuation perspective compared to its peers or, the market overall?
Yeah, valuation is definitely a key part of the puzzle here. Sterling Infrastructure does trade at a premium. Understanding why is important. Its forward price-to-earnings ratio, the PE, is hovering around 28.8.
Okay, and how does that compare?
Well, the industry average is closer to 22.7, and the S&P 500 is around 24.2 times earnings. So yeah, it's higher. But that higher valuation isn't automatically bad. It usually reflects the market expecting, premium growth from the company, which frankly aligns with those strong EPS forecasts we just talked about. It's the market betting on their future earnings power.
Makes sense.
And the price-to-sales ratio, the PS, is about 3.57. That's based on their expected $2.11 billion revenue and a market cap around $7.53 billion. Again, that's, moderately high, but pretty typical for growth-focused companies that are expanding quickly in a hot sector. Now, our sources don't give us a direct discounted cash flow or DCF value. That's where analysts try to figure out the intrinsic value based on future cash.
Right.
But analyst reports, they generally point to a consensus price target near $265. That's roughly 7% above where it's trading now, so they still see some upside. What this premium valuation really tells you, I think, is that Sterling is kind of a show-me stock right now.
A show-me stock.
Yeah, the market believes the story, believes they can execute. If they keep delivering on that growth, there's likely reward. But if that growth stumbles, or they miss expectations even a little, that premium could shrink fast, making the stock vulnerable to pullbacks.
Okay, that's a really clear way to put it. High expectations mean high stakes. So we've got the fundamentals, the valuation picture. Let's pivot to the stock chart itself. What's the recent price action been like? What can the technicals tell us about maybe near-term moves?
Well, technically speaking, Sterling Infrastructure has been on an absolute tear. It's been like a rocket ship lately. The stock has more than doubled, over 100% gain in just the last 3 months or so.
Doubled in 3 months. Wow.
Yeah. It recently hit new 52-week highs, up near $255.59. And something else to note, its beta is 1.40.
Okay, beta 1.40. Remind us what that means practically.
Sure. Beta measures volatility relative to the overall market. So a beta of 1.40 means, in simple terms, if the broader market goes down 1% on a given day, you might expect Sterling to potentially drop 1.4% or maybe even more. It just means it tends to have bigger swings, both up and down, than the average stock. It requires a bit more tolerance for turbulence.
Got it. So fantastic run, but potentially bumpy ride. That makes me wonder about ceilings and floors after such a big climb. Where might it find resistance or support?
Exactly. With the price near all-time highs, technical analysis would suggest there's likely some resistance, potential ceiling, in that $250 to $265 range, which, interestingly, lines right up with those analyst price targets we just mentioned. It's like the market and analysts are kind of agreeing on that zone for now.
Huh. Interesting alignment.
Yeah. And what's also interesting is that some recent forecasts actually suggest the potential for short-term pullbacks, maybe even down towards $173 at the lowest point in 2025, before potentially recovering to around $284 by year-end.
So potential dip before maybe moving higher again.
Potentially. It doesn't necessarily mean disaster. It could just be a healthy pause or correction after running up so fast. It might even offer a better entry point for new investors. And while our sources didn't give specific RSI or MACD numbers, those are common technical indicators, a run-up this strong often pushes those indicators into overbought territory. So for you, if you're thinking short-term trading, this suggests maybe being cautious. Chasing a stock after it's already doubled can be risky in the immediate term, even if the long-term outlook is good.
Right. Patience might be key there.
Yeah.
Okay. Beyond the charts and the numbers, there's always the buzz, right? The headlines, the sentiment. What's the latest news around Sterling infrastructure? What's the general feeling out there from analysts and the market?
Well, the news flow has been pretty positive lately. They've locked down some significant project wins, big interstate roadway contracts in places like Utah, Colorado, and especially Houston. These aren't small deals. Winning these kinds of major projects really speaks to their capabilities and their reputation. And these wins are a big part of why that backlog number is so strong, giving investors that confidence in future revenue. And the analyst community, the sentiment there is overwhelmingly positive. The current consensus rating is actually a strong buy.
A strong buy. That's pretty definitive.
It is. You don't always see such broad agreement among analysts, and they've been consistently upgrading their views and price targets, generally landing around that $265 mark we keep mentioning.
So analysts are clearly buying this story, and that huge backlog seems to back it up. Any other signs, maybe from big institutional investors or even social media buzz, that align with this?
Our sources didn't get into specifics on, say, social media chatter or recent insider buys or sells, but typically you see broad institutional interest, meaning big funds, pension plans, etc., follow these strong analyst ratings and, more importantly, the clear alignment with these huge macro trends. Big money managers are actively looking for ways to play the infrastructure build-out and the AI revolution, and Sterling looks like a pretty direct way to do that. The market's enthusiasm, reflected in that huge stock price run, that certainly points to a widely shared positive feeling right now.
Okay, looking forward then. What are the key events or trends that could really move the needle for Sterling infrastructure? Either, short-term bumps or long-term drivers.
In the immediate future, the biggest thing to watch is definitely their next earnings report. It's expected around August 4th, 2025. Given that really strong EPS growth guidance we talked about earlier, this report is critical. It's not just another update.
Right, it's the proof point.
Exactly. This is where they need to show they can actually deliver on those high expectations. How they perform, and maybe more importantly, what they forecast for the next quarter and year, will likely have a big impact on investor sentiment and the stock price. Looking out longer term, the catalysts are really powerful and tied to these massive economic shifts. First, the continued boom in data centers and other mission-critical infrastructure, driven largely by AI's relentless growth. As AI gets bigger and hungrier for power and data, it needs more and more specialized facilities. Sterling is right there, building the physical foundation for that digital expansion. Second, that ongoing government spending we mentioned, IIJ, CHIPS, IRA. These aren't one-off things. They represent sustained investment over years, which should provide a steady stream of potential projects for Sterling.
So multi-year support there.
Definitely.
Yeah.
And then beyond that, any large new transportation projects or building solution contracts they win will just add further strength to their revenue and potentially margins, building on that already impressive backlog.
Makes sense. Okay, we've talked a lot about the upside, the potential. But every investment carries risk. It's easy to get swept up in the growth story, but we absolutely have to understand what could go wrong. What are the main risks an investor needs to have on their radar with Sterling?
You're absolutely right. Understanding risk is paramount. For Sterling infrastructure, I see a few key areas. First, there are risks specific to their sector. They rely pretty heavily on government infrastructure spending. So if political winds shift or budgets get tight or funding priorities change, that could directly impact their pipeline of projects.
Okay, dependency risk there.
Yeah. And then there's just the inherent risk in executing these huge, complex projects, managing subcontractors, dealing with fluctuating material costs, navigating regulations, handling unexpected problems on site. Any slip-up can lead to delays or cost overruns, which hits profitability directly.
Sure, execution is always tricky on big projects.
Definitely. Then you have broader macroeconomic risks. If we hit a significant economic slowdown, private companies might pull back on expansion plans. Governments might delay projects. That could dampen demand for sterling services. In terms of liquidity, the stock trades about 330,000 shares a day on average, which is reasonable liquid. You can generally get in and out. But remember that beta of 1.40.
Yeah, the volatility.
Right. It means on rough market days, the stock could drop harder and maybe liquidity dries up a bit more than for a giant mega cap stock. Something to be aware of during downturns. And finally, that valuation premium we keep coming back to. It's like a double-edged sword.
How so?
Well, when a stock is priced for near perfection, there's very little room for error. Any stumble missing earnings estimates, a delayed project hitting the news, even slightly weaker guidance for the future could trigger a really sharp negative reaction from the market because those high expectations weren't met. Understanding these risks isn't about being negative. It's about making an informed choice and seeing if this specific risk profile fits with your own comfort level.
Absolutely crucial perspective. Okay, we've covered a ton of ground. The business, the valuation, the chart, the news, the catalyst, the risks. So let's bring it all home. That central question. Is sterling infrastructure a good time to buy now? What's the overall takeaway, and what kind of practical guidance can we offer someone considering this?
Okay, so pulling everything together, the source material we reviewed gives sterling infrastructure a rating of 7.5 out of 10.
7.5 out of 10. So good, but not perfect.
Exactly. That rating reflects a company with, undeniably strong fundamentals, really robust growth potential, especially in those high-margin critical infrastructure areas. But it also clearly flags that the current valuation, combined with that very rapid run-up in the stock price recently, means you need to exercise some caution. It's a solid story, but maybe not a screaming buy at this exact moment without considering entry points.
Right. So if someone is considering buying, what's a sensible approach?
Well, the analysis suggests a best entry range might be somewhere between $230 and $245 per share. The idea there is to try and mitigate some of that immediate technical risk, maybe wait for a bit of a pullback from the absolute peak rather than chasing it right at the top. It aligns better with those analyst targets and resistance levels.
Okay, aim for a slightly lower entry. What about time frame? Is this a quick trade or a long hold?
This definitely seems better suited for long-term investors. This isn't about flipping it next week. It's about participating in that multi-year build-out of our digital and physical infrastructure. You're investing in the company that's actually laying the groundwork for the future, and that story takes time to play out fully. Short-term traders, they really need to be cautious here. That volatility, the potential for pullbacks we discussed, the risk-reward just doesn't look as favorable for a quick in-and-out trade compared to a longer-term perspective.
Got it. Long-term focus. And any tips on managing risk if someone does decide to invest?
Yes, definitely. If you do decide to enter, maybe within that suggested range, consider using a stop-loss order, perhaps set it 8% to 10% below your entry price.
Right.
So, for example, if you buy in at $230, maybe a stop around $210 could help protect your capital if the market turns sharply against you.
Okay, protecting the downside. What about the upside?
On the upside, consider taking some profits, maybe partial profits, as the stock approaches those key levels we talked about, like the analyst targets, around $265, or maybe near the 2025 forecast high, around $285. This isn't about trying to time the exact top, which is almost impossible. It's more about, prudently locking in some gains, reducing your risk exposure, and letting the rest ride if you still believe in the long-term story. It's just smart position management.
That sounds like very practical, actionable advice. Okay, so to quickly recap, sterling infrastructure. It looks like a really compelling story, strategically well-positioned, building critical stuff for our digital future, especially in high-margin areas. They've got the strategy, a huge backlog confirming future work, and the profits seem to be falling. But, and it's a big but, the market knows this. The stock's had a huge run, and it's priced accordingly. So it really seems like one for the patient, long-term investor focused on those big structural trends in AI and infrastructure spending, and being smart about when and how you potentially enter seems key.
Exactly. And that leads to a final, maybe more profound question for you, the listener, to think about. As this convergence of the digital and physical worlds accelerates, and as we face this massive task of rebuilding and upgrading infrastructure globally, how will you tell the difference? How will you distinguish between the companies just riding the wave and the ones, perhaps like Sterling, that are actively shaping that future? What deeper metrics, what qualities beyond just today's stock price or the latest headline will really define the winners in this next generation of infrastructure leaders for your own portfolio?
That is definitely something important to consider. A great thought to end on. Thank you for joining us for this analysis of Sterling infrastructure. Keep exploring, keep learning, and we'll be back soon with more insights for you.